Well, how does your next gallon of gas being 10 cents cheaper sound? At current prices, that's what the Biden administration says families will soon enjoy, thanks to his latest action to lower prices at the pump. But will that actually be the outcome, and will it last or drive the economy towards something worse? To help us understand some of the factors at play is Dave Rapson, an oil and gas industry and electric vehicle expert from UC Davis. Welcome to Fox 40 News at 11.
Hi, Sincere.
Hi there. So yesterday, the president announced that the Environmental Protection Agency will issue an emergency waiver allowing E15 to be sold this summer. This is a 15% ethanol blend fuel that normally can't be sold in much of the country between June 1st and September 1st. It's already in hundreds of gas stations across the country. Is this the answer to combating what the Biden administration has taken to calling the Putin price hike, referencing the war Russia started in Ukraine that's disrupting the global oil market?
Well, Sincere, this is not likely to have a large effect on prices. As the president says, he expects it to be a 10 cents per gallon decrease. That's coming off of a per gallon price of over $4. So that's a pretty small change. But the true cost savings for consumers is likely to be even less than that. And that's because the energy content of E15 is slightly lower than that of a gallon of gasoline. So to drive the same distance, it's going to require buying more gallons. So consumers are going to save a little bit of money, but it's probably not going to put much of a dent in the problem.
Well, that is disappointing to hear for a lot of us who just really have that sticker shock every time we go to the gas station. The E15 move came on the heels of a March 31st Biden administration decision to authorize the largest release from the Strategic Petroleum Reserve since the 1970s, 1 million barrels a day for 6 months. But my understanding is this was done as a sell-off, not an exchange or AKA a loan from the reserve, which is usually what happens. So even though this may drop pump prices right now, it could actually make the market more volatile in the long term. Is that right?
Well, Sincere, oil markets are very volatile in general. And so the Biden administration is making a bet right now that they're going to be able to fulfill the strategic reserves later at lower prices. And if he's right, then that will actually reduce volatility over the long run. But there are lots of reasons to believe that high prices might last for a very long time. And in that case, maybe the reserve will be maintained at lower levels, or they're going to have to refill it at a time when prices are even higher than they are today. And if that ends up being what happens, that will actually contribute to volatility.
My goodness. Well, nationally, as you were just kind of referencing, the record average high for a gallon of gas was $4.33 according to AAA. We hit that back on March 11th. Obviously, in California, we've seen prices as high as $7 in some places. Now, if the market gets to be more volatile in the long term, that's worse for drivers than what we have right now, and possibly we'd be facing faster, steeper cost spikes.
Well, that could be the case, and it's just so hard to predict what's going to happen in oil markets. And the factors are just so large. It depends a lot on what happens with Russian supply in the coming weeks and months. And it also will depend on the economic response to raising interest rates by the Federal Reserve and other central banks worldwide. So there's just an immense amount of uncertainty.
And now that this step has been taken with the reserve, what, if anything, can be done to sort of mitigate the volatility and the issue about replenishing the reserve that you mentioned, and it was already at a low point?
Well, the oil market is global, and so there's very little that the U.S. or anybody really can do to affect that market and control prices and volatility over the long run. But they say that the best cure for high prices is high prices. When you have high prices, that leads consumers to look for alternatives. It leads producers to invest more in supply. And I think that is the pathway to reducing the volatility in the long run.
And we're almost out of time here, but we hear about gas gouging all the time. Congressman Harder has put a gas gouging bill out there looking for $500 million in penalties. We hear about measures to control what companies might do and protect consumers all the time when there's an international crisis like this, or just a crisis within our own country. But then we get back to another point of seeing these proposals come down about gas gouging. So do the companies, they're just making so much money that they don't ever pay attention to this?
Well, the companies are definitely making a lot of money right now, but the question of whether that's because of price gouging or because of genuine scarcity in the market is really the relevant one. It's right now, I think there's genuine scarcity in the marketplace, and high prices are the result of that. And they actually do send the right signals into the marketplace for drivers to drive less when they can, to switch to EVs or more fuel efficient cars, and importantly for producers to invest more in supply. You know, this puts governments in really difficult positions because people hate paying high prices, but really it's the high prices themselves that are going to lead to the long-term structural changes that will reduce volatility and prices in the future.
The oil and gas markets, one of the few things that touches everybody that so few of us really understand. Thank you so much for giving us a few minutes this morning to help us out with that. We appreciate you.
My pleasure.